I'm going to put order flow and price action to the ultimate test to see which one actually makes you money. Because one of these shows you what the market did, and the other shows you who did it. By the end of this, you'll know exactly which one belongs in your setup. And I'll be straight with you about the answer, because it is not the one most people expect. Let's start with price action, because this is where almost everybody begins. This is a price chart. Nothing added, nothing computed, nothing calculated. Just candles. Every one of these candles is a summary of a slice of the market. It gives you 4 numbers: the open, the high, the low, and the close. That's it. 4 numbers and a shape you can read at a glance. And from those 4 numbers, traders have built an entire language: support, resistance, trend, ranges, breakouts, pin bars, engulfing candles, double tops. Every one of those patterns comes from where price opened, how far it stretched, and where it settled. Look along here and you can pick out a swing high, a swing low, and areas price keeps returning to. I didn't need a single indicator to see any of that. The chart just handed it to me. And that is the real strength of price action. It is completely universal. It works on gold, on oil, on stocks, on foreign exchange, on crypto, on anything with a chart. It's free. It's on every platform ever made, and it is never going to stop working. So let me be clear right now. I am not here to tell you price action is useless. Plenty of consistently profitable traders read structure and nothing else. Now let's open one of those candles up. This is the same market, the same period, the same data, but this is a footprint chart. Instead of one solid colored body, every candle is now broken apart into price levels, and at each price level you can see the actual volume that traded right there, split into 2 sides. Red on the left is aggressive selling, traders hitting the bid. Green on the right is aggressive buying, traders lifting the offer. Above each candle you get the totals: volume, buy volume, sell volume. Underneath you get the delta. That's buying minus selling for the whole bar. The shaded band running through the middle is the value area, where most of the business got done, and the line inside it is the point of control. The single price where the most volume changed hands. So look at what just happened here. A moment ago that was one candle. One open, one high, one low, one close. A single colored rectangle. Now it is a receipt for every transaction that built it. That is order flow. Price action is the effect. Order flow is the cause. And the footprint chart you're looking at is free in Noroview. You do not need an upgrade to see this. So let's do this properly. Price action first, the honest scorecard. The strengths are real, and I want to give them their due. It's free, it's universal, and compared to everything else, it's fast to learn. It gives you context better than anything else, where you are in the bigger picture. It gives you clean mechanical rules that you can write down, backtest, and repeat. And it scales. The same read works on a 1-minute chart and on a weekly chart. Now, the weaknesses, and these matter more than people admit. The first one is simple. Price action is lagging by definition. A candle has to finish before you know what it was. You are always reading the past. The second one is bigger. Price action cannot tell you why a level held. Say price comes down into a level, touches it, and bounces away. Did it bounce because buyers stepped in and defended that level with real size? Or did it bounce because there were simply no sellers left and it drifted back up? Those are 2 completely different situations, and they print the exact same candle. And the third one, identical shapes can mean opposite things. 2 bars with the same body, the same wick, the same close. One is accumulation, one is a trap. From the outside, you cannot tell them apart. That's not an opinion. That is just what 4 numbers can hold. So order flow must win, right? Not so fast. Let's give it exactly the same honest scorecard. The strengths first. Order flow is immediate. You're watching the bar get built. It shows intent. You can see who is being aggressive and who is standing still. It separates a level that merely held from a level that was genuinely defended. Take a candle where the buy column is heavy, real aggressive buying, and yet the bar closes red. Buyers pushed, and somebody bigger sat there and quietly took every single one of those buys. That is absorption, and you can see it while the candle is still forming. Price action would show you a red candle and absolutely nothing else. But now the weaknesses, and I am not going to soften them. Order flow is noisy. There is a lot of information here, and most of it is nothing. The learning curve is steeper. Nobody reads this fluently in a week. It needs decent data. A thin, illiquid market gives you a footprint that means very little. It tempts you into overtrading because at this resolution, something is always happening. And here's the big one. On its own, order flow tells you nothing about context. A perfect read at a terrible level is still a losing trade. That one is worth writing down. Which brings me to the answer, and it is going to annoy a few of you. Neither one wins. The question itself is the wrong question. These two are not competing. They answer two completely different things. Price action tells you where to look. Order flow tells you whether to act. Let me make that concrete because this sequence is the whole video. Step one is price action. You find a level, a prior high, a range edge, an old point of control. That is your where. Without it, you are pointing a microscope at random noise. Step two, you wait. You do nothing at all until price actually arrives at that level. Step three is order flow. Price gets there and now you zoom in and ask one single question. Is the aggression at this level being absorbed or is it genuinely running? If sellers are hammering it and price will not go down, that is absorption. Now you have a reason. If sellers are hammering it and every level prints lower, that is a real break. You stand aside. Same level, same candle shape. Two opposite decisions. And only the footprint told you which. That is the edge. Not price action, not order flow. The stack. All right, enough theory. Let me show you this on a real chart. Two setups a price action trader would take on the same market minutes apart. Here's the first one. Price sells off and then it simply stops going down. It builds a base. The same area holds and holds again. That is a support level. Price action says the level is holding, so you buy the break upward. And it works. Price runs straight up, about 4 points off that base. Now here is the question price action can never answer for you. Why did it work? So let's zoom into the entry candle and put the footprint on it. This is the candle the break happened on. Look at the numbers. Volume 126, buying 90, selling 36. Buyers outnumbered sellers there by nearly 2.5 to 1. So the break was not a guess. Real aggressive buyers turned up exactly where the level was. That is what a setup with genuine fuel behind it looks like underneath the candle. Now the second setup a few minutes later, and this is the one that hurts. Price is trending up and it pushes to a brand new high for the move. Price action says exactly what it always says here. The trend is up, so buy the breakout. Every rule you have says take it, and it fails. Price gives it all back. So let's do exactly what we did before and zoom into that breakout candle. Here it is, volume 119, almost identical to the one that worked. But look at the split, buying 70, selling 49. The winner was 90 against 36. This one is 70 against 49. Same volume, but barely 1.5 to 1 instead of 2.5. That is not conviction. That is price being nudged up while plenty of people sell into it. And then watch the very next candle. 23 buying against 44 selling. The flow flipped the moment price got there and the move was finished. Same chart, same trend, the same buy signal, two completely different books underneath. And you could never have seen that in the candle because it is not in the open, high, low, or close. Now, one example is not a system, and I'm not promising you anything here. But that is the question order flow lets you ask before you click the button. Not whether it looks like a setup, but whether there is actually anybody behind it. So which should you learn first? Structure. Every single time. Learn to mark levels, learn trend, learn where the market has been fighting. You need somewhere to point the microscope before the microscope is worth anything at all. Then you add order flow at those levels and only at those levels. And if you already trade price action, hear this. You are not starting over. You're adding one layer and that layer tells you which of your levels are actually real. Everything I just showed you runs in a browser tab. No download, no install. The footprint chart is free, so you can go and put it on your own chart in about 3 clicks. And if you want the full order flow toolkit, there's a 7-day free trial. The link is in the description. Tell me in the comments which one you trade, price action or order flow. Subscribe for the rest of this series and I'll see you in the next one.